In this clip, we'll look at share buybacks. So share buyback is just another way to return cash to shareholders. And it's another method to do that as opposed to dividends or as an alternative to paying out a dividend. So you can see a share buyback as nothing other than a type of dividend payment. So why would a company buy back its shares rather than pay out dividends when they want to distribute excess cash to shareholders? There's various reasons for that, which we'll look at next. But first, what are the accounting entries for a share buyback? So if you look back at the dividends, first part one of the dividends lecture, you'll remember we credit cash, obviously, because we pay, and we debit equity, so we reduce retained earnings. Well, a share buyback, you'll credit cash, because you have to buy back the shares with cash, and you reduce equity, which would be your share capital. So your issued share capital just becomes authorized share capital again. So it's the same, debit equity and credit cash. Same as for dividends. So why would a company rather do this than pay out the dividend? So the first thing is that it's more flexible. It's similar to a special or a bonus dividend. So remember, the company might have a certain dividend policy where they pay out a constant dividend each year or a constant payout ratio. Now this would create an expectation with shareholders. So if you mess with that expectation by paying out a bonus dividend as part of your normal dividend, you might confuse the shareholders, so they don't know what to expect in the future. So that's why we paid out a bonus dividend. Now, another way is you could keep your dividend policy the same, so pay out the normal dividend that they expect, and then buy back shares with the rest of the cash that you want to distribute. Then another reason is to signal certain messages to the shareholders. Remember, management has more information because they run the company. So if they feel that the shares are undervalued, but that it doesn't look like the shareholders are seeing it, so the shares are trading at a value below the discounted cash flow valuation value, then management might try to signal this undervaluation by buying back its shares. Remember, there's no reason to ever buy back shares at an overvalued price, because then you're wasting or you're destroying value. So a company would only want to buy back shares when the shares are undervalued. Also, when the management expect that the share price is going to increase in future, then they might buy back the shares now in order to reissue it later at a higher price. And this way they could try to send out certain signals to the market. Now, the question is it a good investment? So can we see it as an investment? Because we buy at a low price to issue it back at a higher price later on. But if shares are really really bought back when it's underpriced, it's not an investment. It's merely a shift in value from the shareholders that sell the shares to those that don't. Because the shareholders that sell shall sell at an underpriced share price, and the shareholders that keep the share, that did not participate in the buyback, they would receive that increase in value. So no value is created when a company buys underpriced shares. It's just shifted between shareholders. Another common reason is to change the capital structure. Remember, companies would always aim for the optimal capital structure where the WACC, or the weighted average cost of capital, is as low as possible. Now, if there's too much equity in the capital structure, they could raise more debt, but they're expensive and they might not require all of it. So another easy way to change the debt equity ratio to a higher amount of debt is to buy back shares and then reduce the equity that way. Next reason is to offload certain shareholders. So in order to limit the control that certain shareholders have when they have accumulated a lot of shares, the company could buy back shares from the shareholders in order to limit the control they have, or in order to increase the control of the shareholders that stay invested. They could also reduce the risk of a takeover by reducing the number of shares in the market held by shareholders that would sell to a company that is aiming for a hostile takeover. Remember, if the shares are underpriced, it makes the company vulnerable to a hostile takeover because the share price is low and shareholders that might want to take over the company or other companies, they could just buy these shares at these undervalued prices. So if the company buys back the shares first, there's less shares available to take over. It also provides an exit to shareholders where there's limited liquidity. So if a company is not trading in high volumes every day and some shareholders want to get out of this investment, the company could offer to buy back those shares. And then if there's one specific shareholder or a couple of shareholders that is making a nuisance of themselves at the AGMs, then in order to get rid of them, they could offer to buy back their shares, but they'll obviously have to offer a premium, otherwise why would they sell? Another common reason that we see is when companies remunerate CEOs and executives and employees with share options, they buy back shares before and in order to issue these shares when the options are carried out or exercised. If they don't buy back shares before the share options and performance shares are issued, then it might dilute the control of all the other shareholders. Then another reason is to facilitate a management buyout, it's the MBO. So if the management wants to buy out the shareholders or to buy the company, they might not have the available cash. So in order to reduce the equity that they need to buy, the company could borrow the funds, buy back the shares, and then that way reduce the equity. So now there's lots of debt in the company, but very little equity to buy. And that way they basically provided finance to management to buy back or to buy the company. And then just incidentally, the number one reason for share buybacks in South Africa is to increase the earnings per share, which is implied as meaning an increase in value. But remember, if you increase the earnings per share, did you really increase the value of the company? All you did is reduce the number of shares that the earnings are divided by, but the earnings didn't change. So remember, the PE value might also not stay the same. So there's no change in value of the company when you buy back shares, even though they might try to increase the value this way. And then there might be tax consequences. See, I said it's out of the scope for FIM 342 and also for MAF 334, which is probably watching this video now. So you'll do that in PGDA. If you click on the link, you'll go to part 2. We will briefly look at the types of share buybacks and just the Company Acts and JSE listing requirements.